Joey, mate, I'm very excited today. We have one of my biggest virtual mentors in the space. Has been a massive virtual mentor for mine for a very long time, and I know he's a big virtual mentor of yours. But no real shy of an introduction. Pete Wargent, he's one of Australia's most foremost property commentators. If you haven't seen his blog, you're not reading the right places. You're not looking in the right places. But Pete, he's a chartered accountant. He was formerly with Deloitte, and he's really well known throughout Australia. And he's got an extensive television and media presence. And he's a 6-time published finance author as well. And I've read some of his books, and they're incredible. So he has been a buyer's agent. He still is a buyer's agent. He's a strategist. He's a mentor, and he's had a decade of industry experience. But He's tried and tested strategies to assist home buyers and investors to achieve their property goals through making sensible real estate decisions. But Pete, how are you, mate?
Really good. Pleasure, guys. It's great to be on. So, looking forward to having the chat with you guys today.
Yeah, Pete, it's an absolute pleasure to have you on the podcast. I mean, I've listened to you on honestly countless podcasts that you've been on. I'm an avid listener of your high rates. Sorry, give you a podcast a shout. The share investment one. So I'm kind of new to the share investment space. So
low rates, high returns.
Diving in the deep end. Low rates, high returns. Thank you so much. But more importantly, as I said, they're more personal to us. You've been a massive mentor to myself personally. I know Jordan's mentioned it as well. Just listening to you over the last handful of years as I've entered my own property investment journey, and just the commentary that you've given and what I mentioned to Jordan off air, just personally for me, the sense of presence that you give in the highest of peaks and the lowest of troughs really just puts my mind at ease as a property investor, knowing that, hey, we're here for a reason. And you've just been able to really help me through the highs and the lows of the journey so far. So I want to thank you at the top of the podcast.
Yeah, it's interesting. There's an old phrase that things are rarely as good or as bad as they seem, and I think that is often true in real estate. The level of activity through the cycle can swing through some pretty outrageous highs and lows, but yeah, things tend to sort of revert back to an average level eventually. So those old mantras do tend to hold true over time. And as you said, it's usually the people that can keep a cool head and take a long-term view that they benefit from the long-term results of compounding.
Well, maybe you've touched into the very first question that we wanted to dive into, and that's basically, what's your personal philosophy around property investing over the long term, and in particular, exactly that, the longer term?
Yeah, I think, I mean, it's different for different people, but it was my wife that got me into property originally because, as Jordan mentioned, my background was as a chartered accountant, so I was much more interested initially in stock markets and analyzing companies and so on. But it was her that got me into property because we were looking for ways to accelerate returns so that we could could give our full-time career jobs the flick. And her mantra, or her sort of philosophy, which is passed down from her father, was that you buy land and never sell it. And she's been absolutely adamant since the very first property she bought in, I think, 1996 or thereabouts, that you buy property but you never sell it. So, and the thing is, as a guy, intuitively, I always want to trade. I feel like I want to sell properties and buy new ones, but I've been overruled on that. So my philosophy has become, as a result, that you buy property and never sell. And I think as a result of that, it has informed the way that I invest, because I'm basically forced by those type rules to take a very, very long-term approach, to the extent that I tend to take lower risk purchases, I focus on long-term demand and capital growth. And even to the extent where I think about when I'm investing in the UK, for example, we buy farmland because it's inheritance tax-free. So there's it's definitely a long-term vision for me, and that has really come from what my wife Heather sort of taught me right back at the beginning.
Have you ever sold a property to this date? Or have you stuck by that?
I fantasize about it all the time. I'm always thinking, oh, we could offload a couple of properties, maybe in Sydney or a couple in London, and then basically take that money and go and do something more active with it. But I mean, Heather's view, because like me, she's a chartered accountant. She's like, well, why would you want to pay all that capital gains tax when you can just, if you've got assets that have performed for you and things are working, she just thinks, why would you interrupt that? And I think it was Charlie Munger who said you should never interrupt compounding unnecessarily. And touch wood, we haven't had any problem child properties so far. So from that perspective, we just let the compounding continue doing its thing.
That's unreal, Pete, and that's real generational wealth. And I think you guys will love it, you and Heather, but your kids will probably love it a little bit more. So that's unreal, Matt. And I guess, given that you've got kids, given your career history, and touch on if I missed anything in the intro, and your existing portfolio, I guess for me now, like having a daughter, my whole life's been flipped around. I kind of have a different view of what I want out of life and what I want to spend my time on. But what I guess building a successful portfolio for you has taught you the most about life?
I think for us, it was, we were both in very busy full-time roles, professional services originally, as you mentioned, and then both Heather and I went into industry, but we're working phenomenally long hours. And I think the building the property portfolio, for me at least, it just gave me the confidence to go and be an entrepreneur. I'm very envious of people who can quit school at 16 and just go straight out into entrepreneurship. But I just never had that level of confidence or skills or experience when I was younger. But I think I felt that once I had a solid asset base behind me, it gave me the confidence to then go and try effectively going out on my own. So for me, it was partly just about getting some time back. By moving away from full-time job, because having to be in the one place for 60 or 70 hours a week is very constraining especially for my personality type. So I guess that was the biggest thing for me, is that if you've got a good solid asset base that continues to perform for you, it can free you up from those ties to the 9 to 5.
And just out of curiosity, like for you personally, obviously you're quite young. So how did you kind of, in terms of the time frame, did you get to that level sooner than you thought you would have, or did it take you longer? Or obviously you're super ambitious, right? So did you kind of meet that goal at the expected time frame for yourself personally?
Yeah, if you're listening on the podcast, I've got a lot more grey hairs. So I'm not that young. So I was actually. I think we did have a little bit of luck, I think, in terms of timing, because essentially, as you can hear, British background, and the UK went through a tremendous property boom from the mid 1990s, essentially all the way through to the global financial crisis. Prices just, basically tripled extremely quickly. And then we essentially parlayed a lot of that equity into Sydney, and we bought properties in Bondi and Darling Harbour and the Inner West, and essentially by getting a second big property cycle boom back to back, essentially, I guess the results were really good, probably sooner than we thought, I guess. And I think as a kind of model for property investing, if you like, I think that's not a bad one. I think it often takes 2 full property cycles for people to really start seeing the results, because you grow some equity in the first cycle. If you can pull out some equity and then reinvest it, potentially somewhere else, as we did in an area that's set for an upcycle, then it's at the end of that second cycle, then suddenly you can see the fruits of your investing. So and that's pretty much how it worked out for us.
Yeah, that's a great insight. Some people don't even look at the first cycle, but to start off with looking out for at least 2 cycles and getting our value out of that, and pulling out equity from the first one and using that to get into the second one. It's super insightful. But I guess really on the cycles and the economy and everything else, as I touched on at the start, I'm a massive fan of your blog, and I'm always reading it and finding some insights, and you even post things on socials all the time too. So I'm trying to follow you wherever I can. But why do you sort of look at these economic indicators? Is there a real reasoning behind it? And I guess for the property space specifically, is there something or that's most important that you're kind of watching?
Yeah, well, there's an old, very old adage of real estate that says you should find out where people are moving and buy the land before they get there. So a big part of what I do is following demographic trends. And I think part of the reason why I do what I do is that demographic trends tend to follow the economy to a certain degree. So, for example, you'll probably find now with the way commodity prices have been going that Western Australia starts to attract people again, which it hasn't done for years. So, yeah, I think of the things I tend to watch, demographic trends is a big one. Inflation and interest rates, because it has such a big impact on borrowing capacity and your ability and capacity to borrow. Those are other things I like to watch. And also, I just like to look at sectoral trends, but that's more really from a stock market investing point of view, of looking at the sectors that might be out of favour. And also just because I enjoy it, I suppose. I'm quite good at analysis, and I enjoy the process of disseminating information and finding the story. So there's a number of reasons, but I figure it can never hurt to have as much knowledge as you can.
Yeah, that's a really good insight. And I was listening to you on your podcast the other day, and you were saying, just reading and educating yourself over time, everything starts to come together a lot more, and you start to understand how everything sort of has its role and plays its part. So I can just imagine over all the years of you looking at all these indicators and the economic cycles and everything like that, must all sort of fit in together like a big puzzle.
Yeah, it does tend to. I think depending on your personality type, you do need to sometimes be wary of paralysis analysis, if you like. And, I think some people struggle with trying to find the perfect investment or wait for everything to be perfect before taking action. I think that can be counterproductive. But on the other hand, I think you can learn a phenomenal amount just reading the biographies of some of the great investors. And even with some of the worst books, you always come away with something. So I think it's you often find that the old phrase "leaders are readers." I think there's a lot of truth in that. And Buffett and Munger famously spend most of their time reading rather than doing. So I think there's probably something in that.
You mentioned something that I would just want to touch on then about the analysis paralysis, or paralysis analysis, however you want to put it. How would you kind of advise that people kind of see through that? And I suppose I touched on it at the top of the podcast as well, in terms of, I just love your sense of calmness and composure through all the kind of market trends. And how do you, what's your best advice for people who just see doom and gloom in the news headlines, and all they see is the market's going to go up by 30% and first home buyers don't like, you're out of the market, or then the market's going to crash by 50%, everyone sell up and run to the hills? What's your advice for firstly seeing through I want to pick the best investment, so I end up doing nothing, and also trying to read through the hysteria that comes through in the media?
I think a lot of it comes down to timeframes. I think if you're taking a long-term focus, which we have because we've essentially agreed we're not selling, then you're almost you're compelled to accept that through the life of the investment there will be ups and downs. There'll be periods of high and low inflation. There'll probably be periods of high and low interest rates. There'll be times like right now when population growth is low, but other times when it's high. But I guess if you're taking a long-term view, you're essentially accepting all that and just trying to visualize where things might be in 10 or 20 years, rather than trying to predict what's going to happen next year. Because as we should have learned, I guess, with COVID, you just never know what's around the corner, because a pandemic comes along, which wasn't expected. Then, there was a period of time, I guess around March, April, May 2020, when it looked potentially catastrophic for the Aussie economy. And yet, look at the way things are playing out now. Everything is booming. So I think you would look at that and say probably our ability to predict over short time frames is, I wouldn't say useless, but it's pretty loose. So I think the key to it really is taking that longer term view, because then you don't get too bogged down then in unnecessary detail, I guess.
Yeah, that's spot on. And I think through that as well, it's sort of, and I know you're a big advocate of this, and probably one of the main reasons why I started to listen to you in the first place is identifying who you are as an investor and what your investment personality is and what your risk profile is, and really understanding where you sit and where your goals are. How important do you think that is in terms of the overall view of identifying who you are as an investor?
Yeah, I think it's important, largely to try and understand yourself, or know thyself, as they say, the sages would say, and understand why you're doing what you do. There's a couple of reasons. One is I think it's important to run your own race, because practically whatever you do, there will always be somebody more successful than you. We bought some farmland, as I mentioned, but Bill Gates has got $65 billion of real estate assets, whatever it is. There is no point really in trying to compare your journey with somebody else's. Really good reads on that. If you're not a big reader, try reading The Psychology of Money by Morgan Housel, because it's a really short and sharp book on just the importance of essentially just doing sensible things, and not doing anything stupid, because you'll find that the long run results are very good. In terms of personality types, it was actually Steve Moriarty, who I did our podcast with, who introduced me to the idea. There's an assessment you can take called the Enneagram assessment. In fact, we've got a free one you can take if you're interested. And what it essentially holds is that there's 9 main personality types when it comes to money and life. And then there's a whole load of subtypes and wing types that sit underneath that. But what you invariably find, certainly of the people who are listening to this podcast, is probably only about 3 personality types, because those are the ones that place some kind of interest or value on money. And I guess that those would be the achiever personality type, is very driven by money, status, goals, and achievement. Then you've got the sort of the thinker or analyzer, which tends to sit in the middle somewhere. They're the ones who are prone to the over-analysis. And then you've got the adventurer personality type, which is more like myself. We're more sort of prone to experiences, adventure, freedom from being told what to do. And I think the more you read on this stuff, you just think, wow, this stuff is actually uncanny. And it just helps you to understand not only yourself, but it also helps you to understand why other people are the way that they are. It's absolutely fascinating. I highly recommend, if you're interested, take one of our free assessments. You'll be quite interested to see what it tells you about yourself, and therefore what you should do as an investor.
Where can people find the free copy, Pete?
Well, the easiest way is just shoot me an email, I guess, pete@gonextlevelwealth.com.au. It's a really short test. It'll take no more than a couple of minutes, and then we've got an investment map for each personality type. But even beyond that, if you're interested, highly recommend doing some reading on it, because you start to read about these different personality types and think, oh, right, that makes perfect sense. That's why, some people will still be working as CEOs or, senior executives when they're 68 years old. And there's other people who can't, they can't think beyond next year in the corporate world, because it's just all too draining and overwhelming. And that's because, of course, we all have different motivations and different drivers.
Yeah.
So just leading on from that. So, for example, there's like some people close in my life, family or friends, that have, say, a super low risk tolerance. Like, what do you, in your opinion, do you think it's still achievable for them to, say, build out a large portfolio, be it in investment property or shares, even with that low risk tolerance?
Yeah, I think so. I think, some of that comes down to education. I think it's true though. Some people are much less comfortable with debt, and therefore they would probably want the loan to value ratio to be much lower across the portfolio. But it's I still think it's possible, and of course there are different things to invest in. You don't have to do all property. You can do index funds, which tend to be, I guess, a relatively low risk investment in the stock market. But one of the things the Enneagram shows is there are some personality types that just don't have any real interest in money at all. You could go to them and say, look, spend less than you earn, invest the difference, and and this is what it can do for you. But it just doesn't register in the same way, because a lot of people just don't place the same value on that kind of discipline as it relates to money. It's not that it's right or wrong, it's just the way our brains are different.
So I know Jordan and myself, we were kind of, and still are, because obviously we're in that kind of asset accumulation phase for ourselves. So we're a little bit more aggressive in terms of, and comfortable with, say, certain levels of debt and positions of LVR. Did you have like a kind of sweet spot for yourself throughout your early stage of investing in terms of an LVR that you wanted to try and stay under, I suppose?
Yeah, I wouldn't necessarily recommend it for everyone, but we basically, not to oversimplify, but if the bank lent us money, we took it, because my basic thought process was, because we were both higher income bracket or higher rate taxpayers by the age of about 26 or something. So we had high income and therefore borrowing capacity. So we basically just used anything we could get. I guess, if you're looking at the traditional models of risk, you take on more leverage, there is more risk to be managed. But yeah, I guess, that is one of the ways to get faster returns, and that's the way we did it. I was partly thinking that once you go out on your own and start building your own business, there's going to be a period of time there where banks, they just don't look at you as favorably, and that was inevitably going to be the case for us. So we, in our final year of our corporate career, we basically saved up the biggest deposit we could, borrowed as much as we could, and then went on to service that debt over time. But I guess at the high, our LVR was probably 70% or something, and then over time it's just naturally fallen as some of the debt gets paid down, property prices rise, and then before you know it, the LVR is down to 25% or something, and the risk has ebbed away.
And one thing that I suppose that for me anyway, like I never could foresee, if it was like you say, property prices when you guys first started investing in, say, the mid 90s, right? And the property prices were whatever they were. Could you ever foresee them being where they are today? Because that's one thing that I know that Jordan and I on our own podcast previously, other listeners couldn't get their head around. Okay, we're buying, for example, the family home that I grew up in, $90,000, and it's now $2.5 million. Like, did you see that at the time? And like, what do you think now moving forward in terms of like, what are you expecting to see?
Yeah, I think we'll probably see it. If you actually look in nominal terms, I expect price growth will be lower, because, I think back to, if you think back to the early 1990s, we had inflation was absolutely tearing along, and inflation targeting was only introduced in Australia in the early 90s. So I think, it took some time for inflation and interest rates to come down. I think though, a lot of this stuff, there's a thing called the money illusion, and I think if you actually looked at the returns in real terms after adjusting for inflation, they won't be that different in the future, is my best guess. I think the prices might rise more slowly, but of course mortgage rates are much lower. Yields, compared to the rate you're borrowing at, yields aren't that bad. So I guess there'll be ups and downs through the cycle. But yeah, I think actually nominal price growth will be a bit lower. But even then, you see, you get wages growth getting back to 3 or 4%. That's a lot of wealth and incomes that when it compounds away over time, it does go up surprisingly quickly. And I think one of the overlooked things in Australian property, we've all seen a million articles about why prices might fall, but there's no death duty in Australia. So in Britain, it's 40% inheritance tax. So every time somebody dies, the government takes a huge swipe of the estate. But in Australia, it just builds up. So I think if you look at land values in, well, you mentioned the family home in Sydney, the land, it's more real estate wealth. It's a stock more than a flow, and it just builds up over time, and partly because it just gets handed down from generation to generation in Australia.
Yeah, that's incredible. And I guess the real fundamental reason that Joey and I started this podcast was to sort of distill some knowledge that we wish we had when we started building out our portfolio. But if there was sort of three big picture fundamentals that you have taken away from building your portfolio and all the economic indicators that you sort of look at in terms of the property space and property investing, what would they be?
I think the first one, it's more of a principle more than a fundamental, I guess, just the power of compounding. I think our brains aren't really trained to think in terms of multiplication, but if you actually look at what compounding can do to your wealth over time, we take the example, let's say you invest in a property and you use a deposit plus closing costs and you put in, 15%. Well, if you're getting 5% capital growth on that property, it is amazing how quickly you're doubling your wealth there. You can double your wealth and double it again in 6 years. So you project that out over the very long term. We mentioned Warren Buffett earlier, started investing when he was 6 years old, and now it's nearly 90 years of investing, and hence the net worth of 100 billion. So I think the power of compounding is probably the first one, because once you've got that into your brain, you start saving earlier, you start investing earlier, and you try to just give yourself the longest runway possible. I think if I was starting out again today, if I was a youngster again, and of course, we're all much more knowledgeable with hindsight, I think I would actually train as a mortgage broker and understand borrowing rules better than I did. I think the lending landscape was very different before the global financial crisis, because essentially, if you had equity, you could just borrow. It was that simple. If you could fog up a mirror, as they say, you would get a loan. So, but then things really changed when APRA introduced APG 223 regulation, and there's a lot more nuance to it these days. So I think understanding the lending environment is really important if you want to maximize your results. I think the other thing is, and I never would say to people that being a chartered accountant is a bad career. I think it's a fantastic it's a fantastic base to build on because of all the skills that you get, not least in terms of understanding accounts and business and so on. But I think I would have, if I had my time again, I'd probably learn more building skills as well, because one of the things in real estate is you can actually manufacture value, and I think if you've got the potential to buy properties and actually add value to them yourself, that is another tremendous. So I guess those are the main things, the big fundamentals: power of compounding, understanding the lending environment, and if you can understand a bit about developments as well, then that's the perfect trifecta, I think.
Yeah, I think that's a great point. I think it really does come down to the finance. Your second point there, it's really a game of finance, not really a game of property. Property is the asset class and going to get us there, but it really does come down to accessibility to borrow. Yeah,
I think Michael Yardney always says property is a game of finance with houses in the middle. I'm sure he stole that from somebody else as well. So I'll steal it from Michael.
I think we've all stolen a few things from a few people.
So just in terms of that, and I suppose as we come towards the end of the podcast, and everyone else is talking about it as well, so we may as well do it. So just wanted to get your thoughts in terms of more the Australian property market and what you're kind of seeing at the moment. You touched on how finance changed after the GFC? And in your opinion, was that for the better? Obviously, tighter restrictions came into place. Does that potentially safeguard some investors and homeowners? And just, your thoughts in terms of the market, what's happened over the last 8 weeks has been chaotic here in Sydney, and what you think might happen over the rest of the year.
Yeah, I think, I mean, there was a period through the Banking Royal Commission where lending standards they weren't just tight, they were actually ridiculous. The lenders were confused, they didn't know what to do. There was people checking $5 direct debits off bank statements because they just weren't sure what they were supposed to be doing with regard to living expenses. I think, in the end, I don't think the goal of regulators should be to remove risk completely from every loan, and the borrower has to take some responsibility. I think, though, probably capping total debt to income for borrowers, it probably reduces risk overall, though. So I think there's some good. I think sometimes the lending standards were going a bit far in terms of checking, every expense line item, because if a loan's for 25 years, there's going to be, if you spend money on Netflix a week ago, what bearing does that have on your capacity to repay down the track? It doesn't make a lot of sense. But I think overall, maybe just some of the caps on interest-only lending and total debt might be a good thing for the market overall, even if it's annoying for us personally. In terms of the market, I think probably my best guess is that things will calm down in the second half of 2021, partly because more listings will come onto the market. I think possibly as well, there's a lot of construction happening, and that will help to disperse buyers a little bit. And yeah, I think typically frenzied periods don't last for too long. I think things start to calm down as buyers get a bit more circumspect. But I think fundamentally, though, it's going to be a good 3 years for property, simply because interest rates will be low for that period of time, and investors will start to come into the market looking for a return.
Yeah, I saw your post this morning, Pete, that sort of just touched on that, where the owner-occupier finance is slowing down a little bit, but the investor finance, excluding refinances, is ticking up a bit too. So it's going to be interesting to see how that plays out over the next 6 to 12 months.
And just for people who are considering investing in property, I mean, Pete said it 1,000 times, you want to get in as young as you can and give yourself the longest runway. So, and we've said it on our previous podcast, the ups and the downs, and the 5% rise next month and the 4% drop the month after that doesn't really matter when our horizon is forever. So that's super important to keep in mind. And I mean, we've heard it from Pete, who's started that portfolio with the best part of, was that 25 odd years, and he's got he's not as old as he said he is, so he's got a massive runway ahead of him as well. So it's really important to keep that in mind. So, and again, that's kind of what we were talking about, reading through the media hysteria as well. It shouldn't really have any importance, the minor ups and downs. And Pete, has that played with your mindset at all? Obviously over the GFC and the .com bubble and all these other major events in the world, how have you fared through all of that in terms of your mindset?
Yeah, it's interesting, actually. It's a good point, because being being a POM, we've seen our fair share of booms and busts over the decades. I mean, it's a classic boom bust economy in Britain. We tend to have these huge credit booms that end in tears. We had it in the early 90s. The tech wreck didn't, it impacted tech stocks. It wasn't too bad for property. Some commercial property got wallops, but I mean, the global financial crisis hit Europe much harder than it did Australia. And yeah, I mean, if you think back to say around February or March 2009, it's hard to imagine a more despondent sentiment than we had then in Britain. It was, people were really struggling. Unemployment had soared. London prices didn't really drop that much, but out in the regions, a lot of places saw prices fall quite dramatically. And then in Ireland, prices absolutely full on crashed. So I think it's, but it's interesting how things, they do turn around relatively much more quickly than you think. And then before you know it, prices are off to the races again. So I think actually it's a useful experience to go through, because you realize even that, which was, you know, the biggest crisis of our generation, I guess, you know, you do see some periods there where people struggle, but it just reiterates the point really, that if you pick good assets and you've got a long-term view, I mean, I think London prices probably dropped 10 or 15% and then promptly doubled again. So I guess in the grand scheme of things, it wasn't too bad, but it certainly felt pretty edgy at the time, because there was a run on the bank at Northern Rock, and there was very significant implications for the economy.
Yeah, that's unreal to have, you know, multiple economy views, or just having that worldly view and being able to see how things play out differently in different countries. I think that's incredible. I might have to delve in and read a few books about it and look at all the different sort of stuff.
We're pretty narrow-minded here, aren't we?
I know it's pretty crazy, especially being like a younger generation and having, you know, really strong economic growth over the last 25 years. We've kind of never seen anything else. And when coronavirus hit, it was a bit of a shock to the system. So I think it's going to be super important to review what else has happened out there. I mean, you can look at charts and the impact that they've had in certain stages like the GFC and all that sort of stuff, but you really don't get that boots on the ground feel of how impactful it was at that point in time.
Yeah, don't you think with Australia though, that we went through this, the 25 years, there was, what was it? There was the early 90s recession. So it was actually even longer than that. You know, we went through this, what was it, 20 plus years or whatever, you know, without a recession. And then when the recession finally came, it was really odd. It didn't really feel like a traditional recession, because everything was shut down for a period of time. But then the virus kind of just passed Australia by, and then suddenly, before you know it, bang, we've got this enormous stimulus package, and we're off to the races again. I wonder if it will just reinforce the view of a lot of people that Australian real estate is effectively bulletproof. And certainly, I mean, Australia's open economy model and its free floating dollar and control of its own interest rates. I mean, and as a resources rich and clean and desirable country, I mean, you look at all of those factors, it's going to have a good long-term result, I think, especially in those desirable areas where people want to live.
Yeah, it really does come down to those A-grade assets, as you keep honing in on us and having that long-term view. But Pete, mate, it has been an absolute pleasure. You are super insightful. I wish I could have this conversation with you every morning, mate. I would. I'd be a genius.
Yeah, well, I'll be delighted to come back on any time. So let's check in again, maybe later in the year, and see if my prediction was correct or not.
We won't hold you to it, mate, but we definitely love to get you back on.
Yeah, I'll come back on and see where I got everything wrong.
Yeah, Pete, thanks so much again. Yeah, it's been an absolute honor for myself personally, and yeah, looking forward to getting you back on the podcast later on down the track.
Pleasure. Thanks, guys.
Thanks, guys.
Thanks.